In this video, I will be discussing payment and acquisition expenses. As mentioned in a previous video, when a purchase is made with cash, the accounting is relatively simple. However, when a purchase is made through an exchange of stock, it can be a bit more complicated. The application of a stock exchange ratio can help us determine the purchase price. Let's consider the following example. P Company gave one of its $15 par value common shares to the former stockholders of S Company for every 2 shares of the $5 par value common stock they held. P Company common stock had a fair value per share of $48 at acquisition. So before the acquisition, P Company had $15 par value stock and 50,000 shares outstanding for a total balance of $750,000. S Company, on the other hand, had $5 par value and 60,000 shares outstanding for a total value of $300,000. So what we need to do is we need to figure out how many shares P Company is going to have to issue in order to make this exchange. So we know our exchange ratio is 1 P share for every 2 shares, or 2 S shares. And we know that there are 60,000 S shares out there. So we're going to have to issue 30,000 P shares to the stockholders of S Company. So those 30,000 new P shares are going to be issued when the value is $48 per share, which means that our purchase price was $1,440,000 if that was the extent of our purchase. So we only paid in stock by issuing those 30,000 shares. We also discussed in a previous video that sometimes management of the target company negotiates the opportunity to earn additional payment based on performance after the merger closes. This future payment is part of the purchase price and is also a liability that must be assessed at fair value as of the acquisition date. The contingency may require the payment of cash, transfer of assets, or the issuance of additional stock. Contingent consideration can be accounted for as a liability called contingent consideration, or as an equity account called paid-in capital contingent consideration. Whether the contingency is accounted for as a liability or an equity account depends upon the terms of the deal. If the future payment will be made in cash, then it is recorded as a liability. If the future payment will be made through the issuance of stock, then it depends. When the number of shares to be issued is fixed, then the contingency is recorded as equity. Otherwise, it is recorded as a liability. When contingent consideration is recognized as a liability, it must be remeasured each quarter, and the change in fair value will be reported as a gain or loss in operating income. Let's look at an example. In this example, Pratano Company acquired all the net assets of Succo Company on December 31st, 2013 for $2.16 million in cash. The balance sheet of Succo Company immediately prior to the acquisition showed the following. As part of the negotiations, Pratano agreed to pay the stockholders of Succo $360,000 cash if the post-combination earnings of Pratano averaged $2.16 million or more per year over the next 2 years. The estimated fair value of the contingent consideration was $144,000 on the date of acquisition. Prepare the journal entries on the books of Pratano to record the acquisition on December 31st, 2013. Okay. So just like last time, we're going to start with what we got. And so this is an asset acquisition, and so what we got was the net assets. So all of the assets and all of the liabilities. So the first thing we got is current assets. So their current assets become our current assets. To increase assets, we're going to debit current assets, and the amount is going to be at fair value. So in this case, it doesn't matter, the book value and the fair value are the same, but we do want to record them at fair value. We're also going to get those that plant and equipment asset. So again, we're increasing our own assets. So we're going to debit plant and equipment for, again, at fair value. So that's $1.44 million. Now we got our assets, we also want our liabilities. So we added the assets by debiting, we're going to add the liabilities by crediting. And we're going to credit those again at fair value. So that's $216,000. So now we have everything that we got. We got our assets here and our liabilities here. And so now we want to figure out, what did we pay? Because remember, it's just another transaction where we bought something. So that's everything that we got. Now we're looking to record how we paid. So it told us that we paid $2.16 million in cash. So that's going to decrease our cash. So we're going to credit cash for $2,160,000. But the new thing we have here is we also learned that there's some contingent consideration. So in this case, we gave the management of Succo the chance to earn a little bit more if the company performs well. And so what that is it said we would pay $360,000 in cash if this earnings target is met. So when it's cash, remember, it's always going to be recorded as a liability, and that liability is going to be called contingent consideration. So to create a liability, we're going to credit contingent consideration, and we're going to record that amount at fair value. So even though the payout amount is $360,000, right now the fair value of that is only $144,000. So we're going to record it at $144,000. Now, our debits and our credits don't balance, but we have everything that we got, and we have everything that we're paying. And so we're just going to plug our journal entry. In this case, we need a debit to plug our journal entry and make it balance. And if we need a debit, we know that's going to be goodwill. So the amount is just going to be whatever makes this journal entry balance. So we're going to add up all of our credits and subtract out all of our debits to give us $120,000 of goodwill. For Part B, it says at the end of 2014, the estimated fair value of the contingent consideration increased to $200,000. Prepare the journal entry to record the change in the fair value of the contingent consideration if needed. So remember, when we record our contingent consideration as a liability, we're going to have to remeasure it at fair value and continue to adjust that account as needed. So in this case, our contingent consideration was originally recorded at $144,000, and that's still its current value. But now we're saying that we want the balance of that account to instead be $200,000. So we're going to need to increase our contingent consideration. So to make our liability bigger, we're going to credit contingent consideration. And the amount of our credit is going to be the difference between what we want it to be, which is $200,000, and what it currently is, which is that $144,000. So we're going to increase our contingent consideration by $56,000. Now, the offset to this is going to be either a gain or a loss. So in this case, because we're increasing the amount of liability we might have to pay, that's going to be a loss. So we're going to record a loss from contingent consideration. Then for Part C, in 2015, the earnings did not meet the earnout target, and the estimated fair value of the contingent consideration was $0. Prepare the journal entry to record the change in the fair value of the contingent consideration. So we got to the end of the period where management could earn this extra payment, and they did not earn it. So now we know we're not going to have to pay this at all. So first thing we're going to do is take it off of our balance sheet entirely. So we have a liability that we're trying to get rid of. So we're going to debit contingent consideration. And the current balance in that account is the $200,000 that we increased it up to with our last entry. So we want to remove it entirely. So we're going to debit $200,000. And then our offset here, again, when we adjust our fair value, it's a gain or a loss. And in this case, we have a $200,000 liability that we're no longer going to have to pay. So that's going to be recognized as a gain on our income statement. So gain from contingent consideration for $200,000. If instead they had met the earnout target, We would still need to take the contingent consideration off of our books, but we would be paying out cash instead of recording a gain. When contingent consideration is recognized as equity, changes in fair value are not measured or recognized in income. Instead, the shares are issued when the consideration is paid or reclassified if the contingent consideration is not paid. Any costs incurred by the acquirer in the process of completing a business acquisition must be expensed immediately. This includes both direct and indirect expenses. Direct expenses are those directly related to the deal: legal fees to draw up contracts, accountants to do due diligence, and valuation specialists to measure fair value, for example. Indirect expenses are those that a company would have incurred whether there had been a completed deal or not, such as maintaining a mergers and acquisitions group to identify potential merger opportunities. If the merger involves the issuance of additional stock, the costs associated with doing so are accounted for as a reduction to equity rather than as an expense. SMC incurred $1,500 of accounting and consulting costs and $3,000 of stock issuance costs during the purchase of the net assets of B Company. SMC maintains a mergers department that incurred a monthly cost of $2,000. So in order to account for these, the first one is accounting and consulting costs of $1,500. That's going to be expensed immediately because that's a direct expense of the merger. Then we have $3,000 of stock issue costs. Well, those stock issue costs are going to be considered a reduction of capital. So normally other contributed capital is recorded as a credit, but here you see it being recorded as a debit because we're reducing the amount of other contributed capital recorded as a part of this stock issuance. Then finally, we have the mergers department that had a monthly cost of $2,000. That's an indirect expense, and that's going to be expensed immediately through our income statement. This concludes our lecture on payment and acquisition expenses. Don't forget to email questions for our discussion.